Hey, how's it going? This is your professor, neverthelesser, Professor Wasi of Option Snipers University. And today we're going to be going over a very, very intimate video. And this is what I want to call the three biggest lessons from losses. All right. The three biggest lessons from losses. So we're going to go ahead and get right into it. Now, tip number one, or I guess I could say lesson number one, is trading too much. Here's the problem in the markets that I've seen a lot of new traders do. What happens is there is some incremental gain in our portfolios pertaining to maybe entering the day trading or scalping, being able to make, a few couple $100 potentially, or maybe a few couple thousand in the market during maybe the first trade or two. And what ends up happening is a lot of newer traders would then think to themselves, hey, well, I guess I can just keep doing this all day long throughout the entirety of the market today, right? So they'll potentially get into the market close to market open, which is about 9:30 a.m. Eastern, and they would potentially trade throughout the entire day up until 4 p.m. Eastern. And what ends up happening is while you think that you're potentially maximizing on trades throughout the day, what happens is your winning percentage then begins to lessen. Because if you're creating different account positions over the course of, let's say, I believe the market is open for at least about 7, almost 8 hours, right? So if we're looking at it from that perspective, what's happening then is we're spending 8 hours of our day trying to win every single time. And here's the problem with the stock market, it just simply does not happen that way. Okay. There are different things that occur throughout the entirety of the market for a specific day that may not bode well for your portfolio if you stay in the market. So that is lesson number one that I learned from my biggest losses, is that I was simply trading too much. So with that being said, tip two, or what I would say lesson two from my biggest losses, is trading too long. Now, what exactly does that mean, trading too long? That potentially means you enter into a position potentially around the hours of 9:30 to 10, let's say, and you may be holding onto that play for way too long. Now, what's the idea of holding onto a play too long? Well, here's the problem. Essentially, you may have had some incremental green on that specific play, but then decided to hold on to that play for more green. But then you see that potentially whichever way you're currently in that trade ends up going the wrong direction, you end up staying even longer. Okay, here's the problem with holding on to trades too long. What ends up happening is something kicks in called theta. Okay, theta, THETA. And what theta does, it actually eats away at the value of your contract depending on how long or what time of day it is currently in the market. Okay, so if you enter into a position at, let's say, market open 9:30, right, or let's say 10 o'clock. Okay, if you hold that position all the way until 4 o'clock, and let's say you were holding it in the wrong position, on the wrong side, okay, you would essentially lose all of your money on that play. Okay, so we never want to think about holding on to plays thinking that that's what allows us to make more money. That's simply just not true. We're working against both a trend potentially and time. So if the time is against you and the trend is against you, you need to cut your losses. Okay. That's one of the biggest lessons I've learned from taking big losses, is simply the idea that you would have to conserve your capital, and time is going to be the best investment on your capital regarding your portfolio. So if you are in a trade at 9:30, 10 o'clock, and you start seeing that trade go against you with a lot of momentum, it'll behoove you to go ahead and take a loss specifically at that time, specifically because if you hold on to it longer with the hopes of it going the other direction, theta is also equally eating at your contracts. Here's what happens. Let's say you purchased the options contract on a specific key level for a specific equity or stock, and it takes 3 hours for it to go back to that level, right? Let's say we're at a level of 100, it goes down to 75, and then it goes back up to 100 after 3 hours. Your contract price is not going to be the same because of the theta, okay? The theta that's going to be eating away at your contract. It's a time decay, okay? Your time decay is going to start kicking in on your contracts if you hold them for too long. So that's essentially why you need to cut your losses quickly, okay? We have to start learning how to be good losers. All right. So that's lesson number two. Now, lastly, lesson number three is trading too timid. And this is probably the biggest lesson that I learned out of the three, specifically because if you're too timid, that essentially may make you trade too long or be in the market too long, right? Or it's also going to make sure that you're trading too much. Okay, so here's what happens when you're trading too timid. The fact of the matter is that there are better periods in the market where you would be able to trade. That's usually when there's a lot of volatility and volume. Okay, here's what I mean by that. During market open up until and potentially until the hours of about lunchtime, let's say 12 noon, we usually get the most volume and volatility in the market. Okay, so here's what happens. If you are too timid to take the first setup or potentially the second setup after maybe a retest or after you've already had your confirmation and you miss that initial move, what you start thinking to yourself is you start thinking with regret. Now, when regret starts hitting in, you want to counter that regret by trading abnormally after the fact. So what ends up happening is you get into a play after you were supposed to get into the previous one, and what ends up happening is that second setup or that third setup might not be as high quality or as high probable as the first one. So then you start holding on to that contract, hoping that you get the same reaction from the first time it happened, only for you to get a different result. Now, that's what ends up having you actually stay into the market, right? Which was lesson number 2, trading too long, right? So let's say you're too timid in the market and you don't take advantage of what the opportunity presents itself for the first couple opportunities in the market, right? Then you do finally do enter into a position, let's say around 11 or noon, and when there's no volume or volatility during those hours, you're simply not able to make money at all anyway, right? So instead of being too timid, why don't we decide to grab the bull by the horn and make concerted efforts in getting the confirmation we need during the earlier hours of the day trade so that the theta does not eat away at our profits, so that doesn't eat away at our position. All right, guys. So again, I'm going to go ahead and go over the 3 biggest lessons. Lesson number 1, trading too much. We have to stop trading too much. Let's worry about keeping our trades limited to potentially 3 trades a day, no more than 3 trades a day. And when that happens, your mind starts to think about how you need to maximize on those 3 trades. And what I mean by maximizing is getting the best quality setup and getting the best quality exit. All right. So if you're getting a great entry, your ability to then exit even gets greater. All right. So that's lesson number 1. Lesson number 2, trading too long. We need to get out of the markets. All right. We need to get out of the markets. Quite frankly, staying in the market too long is almost always going to guarantee that you're going to be ending the day in red. That's just the fact of the matter. Usually, green days are entered, or sorry, usually green days are finished by noon. Your green days are going to be finished by noon, not by 1 o'clock, 2 o'clock, or even market close. There's too many hours that you're expensing at that time that are making you make bad decisions. We need to make great decisions in shorter periods of time and make those consistently. That's lesson number 2. Lesson number 3, trading too timid. All right, guys. The best hours in the market to trade are from market open till noon. Let's try to keep 3 trades within that window so that the theta or time decay does not eat away at our profits. Why do you guys think these brokerages are making money hand over fist? Time decay is assisting them in being able to do so. If all you're simply doing is throwing your money in the market and allowing time decay to eat at it, what you're doing is you're depositing money into your brokerage account, and your brokerage is simply just taking the money and putting it in their pocket if you're not profiting on it. So we don't want that situation to happen. That's why we decide to tell you guys not to trade too timid. All right, guys. So with that being said, these are the biggest 3 lessons. I hope you take these lessons and make money with them. With that being said, make sure you go ahead and click down below. We have a free Compound Your Confidence crash course. Okay, this is a mini course where you're going to learn everything you need to know to get started, to get your foot in the game, because we need to be participants in this greatest wealth transfer we have in our human history. All right, guys. So again, we have a free link below. Go ahead and click below right now. I'm going to go ahead and give you 2 seconds right now. Go ahead and click it. Free Compound Your Confidence mini course. So many people have been raving about it. It's literally an entry for you to be able to become prosperous in this stock market and being able to pass down generational wealth. All right, guys. So I hope to get more feedback from you guys from getting that course. And with that being said, I will see you soon. Chat soon. Peace.